As you may know if you've been following me, I am focusing on the small positions in my dividend growth portfolio as we get into 2022. This display shows my portfolio, which has 30 total positions. I've divided them into 15 and 15. And interestingly enough, the 15 larger positions are all at or above 3% of the portfolio, and the 15 smallest positions are below 3% of the portfolio. And you can see from this display in the right column that the top 15 positions comprise 72% of the value of the portfolio, and the bottom 15 positions comprise just 28% of the value of the portfolio. What I want to do early in the year or throughout the year as I focus on this low end of the portfolio is to build up the best positions, eliminate the worst ones, or in a few special cases, confirm that I want to keep a couple of small positions for particular reasons that pertain only to them. As an example of eliminating the worst ones, last month I eliminated one of my small positions, 3M, and moved that money elsewhere. In this video, I'm going to tell you how I selected one of the small positions to add to this month, and then we'll review the whole portfolio at the end. I'm Dave Van Napp with the Dividends and Income channel. Before I get going, please help us out by clicking the thumb up button if you like this content, subscribing to our channel, and ringing the bell to get notifications when we post a new video, which is just about one a day. Or if you leave a comment and you get a reply to that comment, you'll get a notification that someone has replied to your comment. Let's get started by identifying the stock I added to, why I picked it, and the impact of the new shares on my portfolio. I won't leave you in suspense. The stock I chose to add to is Merck, ticker symbol MRK, the pharmaceutical giant, which I started last year and I've been slowly adding to every so often since then. Here's what Merck looked like before I made the reinvestment this month. The total position is shown at the top of this screenshot from E-Trade, and the individual purchases are in the other lines. I started the position last May, and I've made 5 purchases altogether, just a few shares at a time. I'm up to 35 shares of Merck. They're worth about $2,700, and they comprise about 1.6% of the portfolio before I make the dividend reinvestment this month. When I'm considering making a purchase, I always look at the quality of the company. To do that, I use my quality snapshot system, which is summarized on this slide. I'm not going to go through all the detail other than to say that the top of the slide lists 5 trusted sources that I use for various ratings that have to do with quality. The safety grade of the dividend, the credit rating, the moat rating from Morningstar, and so on. I score each of those 0 to 5 points. And there are 5 of them. So the maximum score that a stock can get is 25 points. And how I interpret those scores is shown at the bottom. For example, 23 to 25 points means it's an excellent quality stock, and so on across the bottom of this slide. Using that system, here's how Merck stacks up. You can see that Merck is a very high quality company. It gets 24 out of those possible 25 points, just 1 point short of the top score possible. And every category is rated green. The only category in which Merck falls 1 category short of being perfect on the quality snapshot system is its credit rating, which is A+, which is a very good, solid investment grade credit rating, but not in the top tier of S&P's credit rating system. Nevertheless, it's only a 1 point deduction, and the total of 24 out of 25 points satisfies me that Merck is a highly investable company. Now, as a dividend growth investor, I pay particular attention to every company's dividend record. In fact, I'm in the process of developing a dividend snapshot for stocks that I intend to be analogous to the quality snapshot that I just talked about, just for the purpose of examining a company's dividend record, because that is the most important aspect of the company to me. Again, I won't go through all the detail at the top. I do use trusted sources for various rating factors. I do assign, as in the other snapshot, 0 to 5 points for each. The very top one here, Simply Safe Dividends, dividend safety grade. A couple things to say about that. Number one, that was also one of the factors in the quality snapshot, so you see how much importance I attach to dividend safety. And number two, in this dividend snapshot system, I've decided to double weight that score. So each of the factors is worth 0 to 5 points. Case of the dividend safety grade from Simply Safe Dividends, it's 0 to 10 points. I double it. And again, at the bottom of the slide, I show how I then interpret the scores. There's a maximum on this system of 35 points. I consider 31 to 35 to be excellent, and so on across the line. If a company rated less than 20 points on this system, I would not consider investing in it. Under that general system, here's how Merck stacks up. First of all, its dividend safety grade in the first column here is 99. That's the highest grade you can get, and so it gets 5 points. And then I double that, so it gets 10 points right there. Merck has a okay dividend length streak of annual increases to their dividend at 10 years. But I should note that it has paid dividends uninterruptedly for more than 30 years. Its yield of 3.5% is quite good. It's more than the yield of my portfolio, and it's toward the upper end of what I consider to be mid-range yields, which is a 2 to 4% range that I use that term for. Its most recent increase was 6.2% per year, which is good for a stock yielding 3.5%. It has a 5-year dividend increase rate of 7% a year, which is average for the yield. Its 10-year dividend growth trend has been steadily in that range of those two increases, in the mid to high single-digit range. And I consider that to, when you extend it over 10 years of performance, I consider that to be good performance. And in the end, Merck gets 27 points, which is a B grade, very solid dividend record for Merck. So that covers Merck's quality and dividend, which are both great. That brings us to valuation. This display from Fast Graphs shows Merck's price and two fair value lines over the last 5 years going backwards and for 3 years approximately going forwards. You'll note that Merck's price has been stagnant for several years. It's the same now as it was in 2019, even though its profits per share have been growing. I highlighted in yellow annual profit dividend growth rate at the bottom of the slide, and you can also tell that its profits are rising from the trajectory of the purple and blue lines, which are both fair price reference points that are proportionate to Merck's earnings each year. Since those are going up, Merck's earnings have been going up. So Merck is available now at a price the same as it was in 2019, when it was arguably fairly valued. But as its profits have gone up and its prices remained flat, it's created an undervalued situation for Merck's stock. I don't understand why the market does this sometimes, especially extended now over about 3 years in the case of Merck. But when the market does this, it creates one of my favorite scenarios for buying stocks, namely that the company has growing profits, but its price, for whatever reason, is staying flat. That means that its fair value, as shown by the purple and blue lines here, has grown while its price hasn't changed at all. So the stock has gone from being at the high end of fair value range to being fair valued to being undervalued because it's worth more, because its profits have gone up. In the same spirit as my quality snapshot and the dividend snapshot, this slide shows you how I value stocks. Again, I use trusted sources. 3 in this case, and I get 2 valuation methods from one source, which is Fast Graphs, the graph that we just saw. Look at different rating factors, and I add them up and create what I call a valuation ratio, which is the ratio of the stock's price to its fair value as I calculate it. And at the bottom, again, I show how I interpret that number. If it's more than 5% under if the actual price is more than 5% under my fair value calculation, I consider it to be undervalued. If it's between 5% under and 5% over, I consider that to be fairly valued. And if it's more than 5% over that calculated price, I consider it to be overvalued. For Merck, after running the numbers, I concluded that it's a little more than 20% undervalued. All 4 methods agree that Merck is undervalued, and all of them are in the same ballpark as to how much it is undervalued. Now let's translate that generic description of valuation to Merck and to dollars and yields, because I can think you can gauge valuation either by looking at a fair price range in dollars or at a fair yield range in percents. It's the same value, just converted from dollars to percents. For Merck, I get a fair price range shown in the middle here. The yellow area is of $94 to $104, at which point Merck would be yielding 2.7 to 2.9%. Move your eyes to the left. I consider a discount price for Merck to be anything under $94, at which point Merck would be yielding more than 3% or more, as shown at the bottom of the slide at its current price of about $78 and a year yield of 3.5%. Merck is way undervalued. It's a great time to purchase it if you like the company and you like its prospects. In this slide, I simply put together everything we've been talking about. Merck is a mega cap company with a capitalization of $198 billion. It's in the pharmaceutical industry, which is in the healthcare sector. And across the bottom, I show things that we've already seen. The quality snapshot was 24 out of 25 points, which is excellent. The dividend snapshot was 27 out of 35 points, which is above average. The valuation is more than 20% undervalued, which is excellent. And I also took a peek at Wall Street recommendations on Merck. I think there are 30 analysts covering Merck at the moment. It's a widely followed stock. And if you average out all of the recommendations and prognostications from the various analysts, it comes out with a score between 3.5 and 4 on the usual 1 to 5 scale, which is a moderate buy. 4 would be a solid buy, 3 would be a hold. This slide shows the purchase that I made with reinvested dividends. On Wednesday, March 16th, I was able to get 6 new shares at $78.18 a share, which is well within that discounted range that we saw, and Merck yields 3.5% at that price. So I bought 6 shares, increased the number of shares that I own to 41. They cost me $469 and added about $17 a year to my dividend run rate. Now, let's take a peek at Merck in my portfolio again with the new shares added. This again is a screenshot from E-Trade. Today's purchase on March 16th, 2022 is the bottom line on this slide, slightly highlighted in a faint purple. At the top is the summary of the whole position, and it shows now 41 shares, and the proportion of Merck in the portfolio has risen a little to nearly 1.9% of the portfolio. So Merck is still a small position. It's less than 3% of the portfolio, which means that as opportunities arise, and if the story and quality of Merck stay roughly the same as they are now, and it's fairly valued or undervalued the way it is now, my intent is to continue to add to it from time to time and build the position up beyond 3% of the portfolio eventually. This display shows the impact on the portfolio's annual income of making that purchase of 6 shares of Merck. Before I made that purchase, my annual dividend run rate for the portfolio was $5,529 per year, which is an 11.8% yield on cost. And after I added the 6 shares, that jumped up by the $17 we saw that it added to $5,546 per year. And that just edges up when rounded to 1 decimal place the yield on cost to a new record high of 11.9%. As I discussed in my recent video on yields, the 11.9% yield on cost means that the portfolio is now sending me cash dividends at the rate of 11.9% per year of the original amount that I used to start the portfolio back in 2000, and I think that is really cool. If you have seen my videos before, you have seen this chart before. The 3 main reasons why dividends grow over time in a dividend growth portfolio. The 3 circles: number 1, stocks increase their dividends; number 2, I reinvest the dividends; and number 3, as a portfolio holder, you or me, make occasional adjustments, which means trims, sales, swaps, change out things you don't want anymore, and so on. Those 3 activities, in sum and when blended together, cause the dividend income of the portfolio to rise. And the chart to the right isn't just a generic illustration. It's actually the dividend record of my portfolio from the time it began in 2008 to the end of 2021, a couple of months ago. And it's been going up. The dividend rate has been going up at 10.5% per year pretty steadily for those years since 2009, which was the first full year of the portfolio. One thing I've added to this slide since the last time you saw it is that bracket to the left with the sideways label that says things you do. I simply want to emphasize that while number 1 is a function of what companies do, they raise their dividend, circles number 2 and 3 are the responsibility of or the result of activities that the owner of the portfolio makes. reinvesting dividends and adjusting the portfolio are decisions that we as portfolio owners make on our own. This slide shows for my portfolio the dividend increases so far in 2022, which is circle number 1 on the previous slide. I've highlighted in yellow 1, 2, 3 of them that I found out about since the last time I showed you this chart last month. And you can see at the bottom that 14 increases now have been announced to be effective this year for stocks in the portfolio. They add together, they're starting to add up to $139 per year, or 2.6% per year to the annual dividend run rate. This slide shows circle number 2 for reasons that dividends go up in a dividend growth portfolio, which is dividend reinvestments. And here I've highlighted the investment we've been talking about in this video for March, the purchase of 6 shares of Merck that added $17 to the dividend run rate. So these are starting to add up. I'm now added a total at the bottom of $50 per year, or almost 1% to the annual dividend run rate. If circle number 2, activities, dividend reinvestments, continue at the same pace all year, now having 3 of them, we can multiply by 4 and see that by the end of the year, through dividend reinvestments, I would have bumped up the dividend run rate by 3.6% per year, which is not insignificant, even though each individual reinvestment seems like very small potatoes. They add up. We're getting near the end of the video now, and this slide shows the important statistics from my dividend growth portfolio, and I've red circled what we've been talking about mostly in this video, which is the annual dividend run rate, which with the purchase of the Merck shares has advanced to $5,546 per year, which equates to a yield on cost of 11.9%, which is a new record high for the portfolio. While you're looking at the portfolio, I'll give you these fast facts about it. First, the positions are sorted in the table alphabetically by their ticker symbol. The portfolio began in 2008 as a way to demonstrate dividend growth investing. It had an initial value of just under $47,000 when I started it. It's now worth more than $171,000, which is 263% growth. That growth has been achieved with no new money ever added. In other words, all the growth is organic, meaning that it's come from the 3 circles that I showed you: dividend raises, dividend reinvestments, and occasional trims and swaps. I started with 10 positions in 2008. I now have 30. The annual income has gone up at about 10% per year and now stands at about $5,500 per year. And as we've seen, the yield on cost is now 11.9%. And with that, we've come to the end of the video. Thanks for watching, guys, and I'll see you next time. Bye-bye.